Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking energy, talking about crude oil. An early rally kind of stalled. The US-Mexico deal rallied crude early on with the idea that there would be more demand and there wouldn't be any interruption of the sort of heavy crude that comes out of Mexico that's used for things like blacktop and other products. NAFTA was part of that, and that was part of the agreement that happened along with the auto part of the deal, giving this idea that gasoline demand wouldn't be hurt by any sort of frustration or any sort of friction in car production between the US and Mexico. So that early rally came in late yesterday, continued in through the morning, but then faded as the day went on. Crude oil got above $69 on the WTI side, 69.20 was the high, and then we went down 70 cents and settled closer to that mid 68 range. Now the US dollar weakness continues to sort of put a floor under most of the commodities, and that did help crude over the last couple of days. We had a 2-day in a row winning streak and 6 of the last 7 days. Now with today, we end that 2-day streak and we end up with 6 of the last 8 days higher, 2 days lower over that 8-day span in crude oil. And again, a lot of pressure being put on by these the sort of underlying theme of seasonality that's going to start playing effect. We got a build last week in gasoline, and if we continue to get these gasoline builds going into the end of the summer driving season and refinery turnaround, that's going to put a little bit more pressure on crude oil. And that's what we're going to see in the API and the EIA data over the next couple of days. Both are looking for small draws in crude oil, smaller than we saw last week. We're in the multi-million barrels for both the API and the EIA. But we got gasoline builds and we got a jump in refinery utilization last week. So the API number, we're just going to look at the headlines as to whether there's draws or builds. If there's builds in both, that's going to put a ton of pressure on crude oil going into the EIA figures, where you can look at that refinery utilization number and see if potentially they've slowed their refining of crude oil, meaning they've slowed their draws out of storage into the refineries themselves, turning it into gasoline and stockpiling gasoline for the end of the summer driving season prior to shutting those refineries down to change over to winter blend. Now we currently have gasoline levels 6% above their 5-year average. That build last week added to that. If we get another build this week, it's really the gasoline build and the refinery utilization number coming out in the EIA figures that matters for crude in the short term. This is Bob Iaccino talking about a slightly weaker crude oil market from the CME Group trading floor in Chicago.